Hey guys, Josh Cantwell back again from Strategic Real Estate Investing Radio, and I'm really excited to bring you back another edition of Real Estate Investing Made Easy. As always, I'm going to be your host, and I'm really excited today because I have one of my very good friends on the line with me today to specifically teach and talk with you about self-directed investing. My guest is Brian Ellis, the founder and publisher of the Brian Ellis Investing Letter. And Brian is well known in the real estate and the financial markets and the retirement planning markets as being, let's say, brutally honest with how investors should be investing their dollars, and his opinions and his take on real estate and the financial markets. And so Brian's going to shed some light with us today, specifically on self-directed IRA investing and some ideas and strategies to juice up the returns in your IRAs, but while making them as safe as possible. So Brian, thanks so much for joining me today.
Hey, it's my pleasure, Josh. Thanks for having me.
You got it. So Brian's been investing in real estate for years. I actually met Brian back in 2007, 2008 for the very first time. He's been the author of many different training programs and has been featured speakers on many different real estate investing and internet marketing and business development programs. Travels all over the world. Brian is particularly fond of Las Vegas, and I've had the good fortune of spending some time with Brian in Vegas, even though Brian's not a gambler. But Brian and I have a lot of things in common. We really like the concepts and strategies about working with very affluent investors, people with a substantial amount of money who are looking for alternate investments, in the stock market and outside of the stock market. And so, Brian, why don't we just start? Why don't you just give us a little bit more color about you, your background, a little bit more about the Brian Ellis Investing Letter?
Sure, Josh. Well, I come from a little bit different vantage point than most. I think that affluent investors specifically they really are interested in generating strong returns, but they don't really care all that much about becoming a master of their strategies themselves. What they want is relationships with people they can trust. And so that's what Self-Directed Investor Radio is really all about, our podcast. And the fundamental idea there, Josh, is that we as self-directed investor, and a self-directed investor, by the way, is not just somebody who has a self-directed IRA or 401k. It's anybody that takes control of their own financial situation, their own investment portfolio. They might have a financial planner, they might have real estate brokers, they might have stock brokers, etc. But at the end of the day, they make their own decisions. That's who I serve. And ultimately, Josh, what we've realized is that a self-directed investor has one core value. A wise self-directed investor has one core value, and that is that they must respect their own capital at all times. There might be, like I said, a financial planner involved. There might be brokers. There might be advisors. There might be lawyers and accountants and such, and there certainly are. But at the end of the day, self-directed investors make all their own decisions, and so we've got to respect our own capital, and we really have to do that through kind of a framework that we talk about called the S3 standard, the S3 criteria: simple, safe, and strong. And so that's really where all the brutal honesty comes from, is comparing investment opportunities to the simple, safe, and strong model. And whenever an investment doesn't fit that model, well, we have to point it out. So that's kind of the overview of who we serve and how they think.
So Brian, simple, safe, and strong, the S3 model, that sounds great. And simple, safe, and strong, those three words, I think, are words that anybody who can speak the English language kind of understands what those mean. But sure, what does that mean for you and your take on how does those apply specifically to self-directed investing?
Well, Josh, that's a great question. And let's use an investment that I know that you're involved in, the hard money business. I think that's a beautiful example of something that does fit the simple, safe, and strong model. Let's talk about why. Is hard money lending simple? Well, yes, it's a loan. Who doesn't understand a loan? and it's a loan that's highly collateralized. That makes pretty good sense. The simple standard is really all about one question. Can you explain what you're doing in 30 seconds or less to a person of average intelligence and have them go, that sounds pretty interesting? So it's got to be simple. Complexity hides risk. That's all complexity does. So simple is important. Safe. Do you have a plan B? You know, if you're investing in stocks, you can make money in stocks. I'm not suggesting anything other that's not true. But if you're wrong about the stock you choose, you're going to lose money, period, and there's nothing you can do about that. But with your investors in your hard money lending fund, if they lend money and the borrower doesn't pay, well, you almost have to do a happy dance, because you're probably going to make more money that way than if
Right.
than if they had paid, because you've got good, solid, strong collateral.
And you've heard,
And
Brian, I'm sure some hard money lenders, they lend to own, right? They
yeah,
specifically lend probably maybe more dollars. Maybe they lend 75 or 80% loan to value. They lend because they want the asset. Some guys lend. We don't lend to own because I don't want to foreclose on my students.
right,
But
right.
I love the analogy of being very safe and having a backup plan. And yes, there are cases where we have defaults.
Yeah.
But a default doesn't mean there's a loss, because there is plan B, plan C, plan D.
Yeah, it's that you have a plan B, and the reality is that you don't have the option of using that plan B anytime, but if you get to use it, you're probably going to do better that way. So hard money lending is simple, easy to understand. It's safe because there's great collateral, and the returns, let's face it, the numbers are really impressive. Double-digit returns solidly, easily. It's a beautiful, beautiful thing. So you've got to have all three: simple, safe, and strong. And there are a lot of investment opportunities, a lot of investment or asset classes that are strong, and maybe they're also simple, but they're not safe. It's easy to get one or two of those characteristics. Getting all three is really tough.
That's great. Yeah, that's a very great explanation too, Brian. Simple, safe, and strong, S3. Did you come up with that yourself?
I did.
That's wicked, man. I like it. It's so
Thank you.
simple. It's wicked. I enjoy it, man. That's great.
Thank you.
So, Brian, when you're working with affluent investors, coaching them, teaching them, you host your own podcast. What kinds of investments are out there that are simple, safe, and strong? You mentioned hard money lending. We underwrite and originate loans and notes, and we sell those to our fund. We sell those to one-off investors. We're now starting to sell them to institutions. Institutions are looking for even an 8-9% yield. They're happy with, because they have so much money. They just can't afford to have it sitting on the sidelines. But outside of hard money lending, which you've mentioned, and I appreciate that because I'm in that business. What are some other things that people are looking at? You're talking to these investors, affluent people that are self-directing. What are some other different strategies that they look at?
Well, kind of related to hard money loans is the whole notion of note investing, real estate note investing, and it's kind of a similar thing. It's just that hard money lending tends to be higher interest, shorter term, and real estate notes tend to be a little bit lower interest but longer term. And if you buy the right type of real estate note, that can absolutely be simple, safe, and strong. But Josh, really, there's kind of a trifecta that I recommend of investment classes, asset classes for my clients, and they are certainly real estate secured debt, such as hard money loans and notes, tax lien certificates, and other tax lien type investments, and along with high equity position cash flowing real estate. We like rental properties. We like both commercial and residential, but there has to be enough equity from the outset that if we're wrong about that market, that we can get out of that property quickly. Because really, Josh, at the end of the day, rule number one is never, ever, ever lose money.
That's right. I love it. So, so real estate notes, whether it be hard money, real estate notes in general. What I love about the note business, I learned the note business from several different guys years ago. I wasn't really a note investor for a long time, but I love the idea of a note being very similar to a bond. Note has a yield or a coupon, just like a bond has a yield or a coupon, and you can buy that note below the par value. So if a note has a value of $100,000, you can acquire that note at 90. That makes your overall return, because at the maturity of that note, it's like the maturity of a bond. You have the upside of the value going from $90 back to par value at 100 cents on the dollar, plus you have the yield or the coupon that it's paying. Let's call it 8% or 10 or 12, whatever. And it's just like a bond, and it's, but in this case, again, secured by real estate, which gives you Plan B, Plan C. So
Yes,
I
exactly.
love that.
Yeah.
How
Tremendous
about,
opportunity.
yeah, tax liens and tax lien certificates. So I know a few guys that have invested in tax lien certificates that do that kind of stuff. Why don't you elaborate on that a little bit more? That's not something that I'm, intimately involved with.
Yeah, so the way that tax lien investing works is this. Imagine Joe homeowner, and he owns a piece of real estate, and he hasn't paid his property taxes. We've all got to pay our property taxes, but Joe didn't. So Joe probably owes maybe, who knows, he's got a $100,000 house. He probably owes $10,000 worth of taxes by the time that the county decides to take action. And the type of action that they take generally works like this. They'll take that $10,000 debt that they have, which, by the way, is superior to every other debt. It's superior to the mortgage. It's superior to the IRS. It's superior to everything. They'll take that $10,000 debt and they'll sell it to an investor like you and me. And there is an interest rate attached to that $10,000 debt, and it's generally pretty high. It can get up to upwards of 20% here in Georgia, and there are places that it's much higher than that. But here's the cool thing. The person like me or you who buys that $10,000 debt, we've got to pony up a $10,000 check to the county. But what's going to happen is one of two things. Either Joe homeowner is going to pay off his property tax debt along with the interest that is due according to state law, or if he doesn't, we do better. What happens is that we end up owning that property, owning the entire property for that cost of $10,000. And remember, it's a $100,000 house. So the leverage is really, really massive there, but most deals don't end up converting into real estate. Most deals end up getting paid off. So you write the $10,000 check, and maybe you're in a place that gets 20% interest over a year. So sometime in the next year, you're going to get a check for $12,000, and you will have taken almost no risk at all, because at the end of the day, if that person can't pay off their property tax plus your interest, you get their house. So that just doesn't happen all that much. It's a beautiful, beautiful, and very safe way to invest your money if you do it wisely.
And the tax lien certificate and tax lien business, Brian, is a state-by-state deal, right? And it's administered at the county level. So if you're in the state of Ohio or the state of Illinois or the state of Georgia, the state of whatever, these tax lien certificates already carry a predetermined fixed coupon. Is that right? Like a fixed interest rate.
Yes, that's right. That rate is set by state law, and in some states that rate can fluctuate depending on whether you buy that certificate at auction or not. But if you go directly to the county and buy, you're going to get whatever the state mandated rate is, and it's usually a very attractive number.
I mean, I've heard things like, I think it's Illinois, it's 36%. And
I know a number of people who focus there, yes.
Yeah, and maybe it was Maryland was 18% or something along those lines. And
yeah, the numbers are very high.
Yeah, so and I love the fact that those tax liens are in superior first position before any mortgage at all. And believe it or not, people inherit houses, right? And they have tax liens or tax that they have to pay, or somebody buys a house, pays it off, but then they get into a circumstance they don't have the money. They don't have the money to pay $5,000 or $10,000 worth of tax liens, and these properties that have no mortgage go into tax lien foreclosure. It's amazing.
It's horrible. It's sad, but yes, it does happen frequently.
And Brian, what about the high equity cash flow position? So if somebody is going to go into a market, and maybe they're a virtual investor, and they know that they want to go into that asset class and own, high equity cash flowing rental properties, what are some criteria they should look for there? How much equity should they get into? How much cash flow per month should they be looking for to be properly secured or properly, diminish some risk?
Well, Josh, there's kind of an epidemic going on right now among affluent investors out there, and that is the advent of this thing called turnkey rental property investing. There are a lot of companies that do that in a great, solid, wonderful way, but The business model there that most affluent investors end up getting involved in goes something like this. The affluent investor shows up at an event at some hotel, and someone stands up in front of him and says, "We've got all these great deals. We've got a property manager that we've already vetted. You can buy these houses. They're going to be full of, and they're already going to have a tenant. They're going to have management in place. All you got to do is write the check. And by the way, the price you're going to pay is based on a cap rate." For anybody who doesn't know, cap rate is basically an expression of the percentage return you're getting on an annual basis from the income from real estate. And cap rate is a very well-established way to value property, but it is a deceptive way to value property for single-family property. But most of the affluent investors who buy these houses don't realize that what they're doing as a result of buying on cap rate numbers, which is not relevant for single-family houses, is that they are paying at or above the retail price. In other words, if they were to go out and have that property appraised for a cash value, they're paying more than that number. And Josh, here's the reality. You won't find any investor out there who's been very successful and built a large rental portfolio who said, "Yep, my secret of success was paying more than the property was worth. That's what I did every time and it worked for me."
That doesn't work? Come on.
Yeah, it's probably not the best idea. Probably not the best idea. So
you're using a cash flow rate, a cap rate, which makes a lot of sense in commercial or multifamily.
Yeah, exactly.
Makes really no sense not a lot of sense in single-family residential, because comps for single-family residential is the house next door. It's the house down the street.
Yeah, exactly.
It's a different comping model than just how much cash can you make.
Yeah, and it's a higher risk model too than a commercial property or a multifamily property, because you have one tenant and one tenant only, and if they leave, then all your cash flow dries up, and that's it. Right. So it's not a relevant model for single-family properties, and so I really recommend that anyone interested in doing long-term holds, particularly rental property type investments, make sure there's some equity on the front end. And you know what? The reality is it's sometimes hard to find deals where you can get much equity. I mean, I tell people that the more the better is always the best rule, but is it likely that somebody who their job is not real estate, who's a doctor, a lawyer, an accountant, a professional, a business executive, is it likely that person is going to have the time to go out and find a deal that they can buy at 60 cents on the dollar? Well, probably not. So I tell those people, at the very least, and this is kind of the bottom line, always buy your property at a price where if you wanted to resell it tomorrow, you could get out of it, not get hurt, pay all the fees, and be even. That probably means at the extreme high end, you shouldn't pay more than 90% of the value of a property, and that's the extreme high end. I'd really like to see people at more along the 70 or 80% level, but again, that's hard for non-professionals to do. So the bottom line here, Josh, is just that people need to make sure that they have an exit plan in place. They have the ability to get out of the deal without it crushing them. That's my advice on that topic.
Yeah, and I agree with you on that 90%, because if I look back at my own deals that I've bought fixed and flip, I've been tracking my numbers for nearly 3 years with our buy, fix, and flip model, and on average, when we sell a house, we have about 10.5% is the expenses for realtor commissions, closing costs, seller concessions, and those kind of things. So you got to have at least 10% equity just to cover your selling costs if you're using real estate agents. And of course, you should use a real estate agent to sell a house. You're going to get a lot more exposure. So at least 10%, and that 70 to 80% model definitely gives you a little bit more equity for a downturn in the market. Maybe you need to get out really quick for some reason and just sell at a slight discount to procure a quick buyer, or just cash out with some additional equity on top of the rents that you've received and the profit along the way. And the other thing I would add is even if you're a passive investor and you're not vetting the property out yourself, you're not a professional real estate investor, and you're just not sure, hire an appraiser. Hire an appraiser for a couple $100 to go out and look at the property based on the comp model, and that could essentially, it could save tens of thousands of dollars down the road by getting a wrong value based on, like you said, the cap rate model.
Absolutely. That's great advice. You should always have property appraised for its cash resale value independently, even if that's not the number that your vendor is working with.
Yeah. Now, Brian, we talked about this S3, very simple ways, safe ways, strong ways to invest as a self-directed investor, whether it's with a self-directed IRA or just cash on hand. But there's also some things you really shouldn't do, right? Things you shouldn't do that you could blow up your self-directed account if you have an IRA or a self-directed 401k. There's some things that are kind of no-nos out there. So before I kind of let you go, you know, I know there's people out there that think, wow, this is great. I got 3 new strategies to invest. I'm learning a couple great little nuggets. And I certainly, Brian, want to give everybody the opportunity to come visit your website and visit your podcast. But there's you know, we don't want to freak people out, but there's some things they really shouldn't do. So why don't you just elaborate on that a little bit, so they know, hey, you know, avoid these things at all costs, because you can blow up an account and trigger a significant amount of taxes and penalties by making some mistakes.
Yeah, that's really true, Josh. I'll give you an example of how easy it can be to make one of these mistakes, but I think probably first the important thing is for everybody to understand how critical it is to avoid these mistakes. There are certain things that you can do that are classified by the IRS as what's called a prohibited transaction. In layman's terms, that means you've done something the IRS said you shouldn't have done with your IRA specifically. So bottom line, if you commit one of these prohibited transactions with an IRA specifically, the rules are a little different with 401ks, but with a self-directed IRA specifically, your account is messed up badly. Just the real problem is that these prohibited transactions usually aren't caught for years after the fact. But the problem is once they are caught, whatever year the prohibited transaction happened in, from that year forward, every benefit you've gotten as a result of having that IRA vanishes. And so what that means is maybe you've experienced you've made a lot of savings on your taxes from putting money into a traditional IRA. You've taken deductions right away. Well, what it means is you've got to pay all that back right away, plus penalties and interest. It also means that if you happen to have experienced a great profit in that account in that period of time, and you didn't pay income taxes on it on the basis that you were using an IRA, well, now you've got to pay those taxes, plus penalties, plus interest. Folks, the bottom line is, whenever this happens, it can wipe out your account, like going from wherever you are to zero. It's a really, really ugly thing, and furthermore, it's not easy to correct. It's not something that you can just make a call or write a letter and get it resolved. But Josh, here's a really simple example that has some problems that anybody could find themselves in this situation. Imagine that you have a self-directed IRA and you have purchased a rental property in it, which is, you know, maybe a good thing for you to do. And you've also done something smart. You've hired a property manager so that the property manager is taking care of everything. They're finding the tenant. They're doing all the maintenance. They're handling everything. And tomorrow is your big open house. The property manager is put on an open house, and so there's going to be a lot of people there. You want it to be just right, and you're curious, so you drive by the property today, and you see that there's a little problem with the mailbox. You see that the mailbox flag is dangling. Some kids probably walked by and broke the mailbox flag, and now it's dangling, and it just looks a little trashy, and you want to fix that. So you go down to Home Depot. You spend $5 on a new mailbox flag, you come over, you install it. All good, right? Well, not so much. You've got 2 problems there, or 2 potential problems. One of them is that you used personal money. You took money out of your pocket to benefit and use that to benefit the value of your IRA. That is technically a disallowed contribution. That's something you can't do. You can't use your own money. You can't mix your personal money with the IRA, even though it's only $5, even though it's only a mailbox flag. But the other thing is you use your own labor to install that. This one's a little bit more gray, but the reality is the IRS can make a very reasonable argument that since you weren't compensated for that labor, that you've made another contribution to the IRA that was disallowed. And Doing those things could result in your IRA being classified, as we just discussed, as fully distributed. That's the result of committing a prohibited transaction, and that's Armageddon. So what I would tell you folks is two things. Number one, be very careful. Go ahead and always get legal advice, even outside of your custodian. Your custodian, they have a tough job. They're kind of the interface between you and the government for your retirement account. And that's kind of a tough job. It's not their job to make sure that you don't break the rules. It's your job to make sure you don't break the rules. So get legal advice anytime you do a complicated transaction. And secondly, consider using a self-directed 401k rather than a self-directed IRA if you qualify for it, simply because I think the biggest benefit of a self-directed 401k is that correcting these prohibited transactions in a self-directed 401k is fairly simple, it's fairly inexpensive, and it doesn't mean that your account is entirely blown up and that you're going to face financial Armageddon. So that is my overall approach and theories about prohibited transactions.
That's fantastic, Brian, man. That was great insight. I love the little story about the the paint can and painting the mailbox. It's simple, something as simple as that, right?
Yeah, absolutely.
Can really cause financial Armageddon. We'd hate to see that happen. So, Brian, listen, thanks for all your insight. This has been a great opportunity. I've definitely taken a bunch of notes here. Brian, for people that want to get more information about your podcast or your website, start to follow you and get a little bit more information about the Brian and Ellis Investing Letter, or listen to your self-directed radio, where can they find your information and look you up?
Well, yeah, for you guys who have some capital and are just looking for really intelligent ways to deploy it, the Self-Directed Investor Radio Show on iTunes is a great way for you to get that information on a daily basis. We do 7 minutes a day. It's short, it's tiny, but it's very impactful. You can find that at sdiradio.com, sdiradio.com, and I think you'll like it.
Very good. Well, Brian, thanks so much for being here. I really appreciate your insights. I know our listeners are gonna love it. And as you listen to this interview, if you're in the iTunes platform, leave us a 5-star rating. If you would, leave us a comment for myself and Brian so we know how we did today. Leave us some feedback, whether you like this episode, and also information about what future episodes you'd like us to deliver. Information if you want more from Brian, or for us to take a deeper dive into self-directed IRA investing, I'd be happy to have Brian come back. So leave us a comment, leave us a rating right there on iTunes. I really appreciate that. If you're listening to this on our website, leave us a comment right there on the website. Brian, thanks so much for being here today. I really appreciate it.
Thanks, Josh. It was my pleasure. Thank you, everyone.
Guys, this is Josh Cantwell again with StrategicRealEstateCoach.com, your host of Strategic Real Estate Investing Radio. We'll talk with you soon. Take care.